I'm delighted today to welcome you all to our second Fund Manager Q&A webinar of 2023. And I'm joined today by AJ Krishnan from Wasatch Advisors, one of the managers of our Emerging Markets Equity Fund. AJ is joining us from Utah today, which the more switched on amongst you will work out that if it's 12:30 p.m. here in the UK, AJ is dialing in very early in his day at 5:30 a.m. So straight away, thank you for doing that for our clients, AJ. We can
Absolutely.
see it dark behind you. It may get lighter as this goes on, but we'll all gauge that. But yes, thank you very much for that. And now AJ has managed the Emerging Markets Equity Fund since 2014. A combination of the popularity of the fund and excellent compounded return has resulted in the fund now being nearly £3 billion in size across all the wrappers. We'd like these sessions with fund managers to focus on the funds themselves, although we will, of course, touch on the wider economy and other topics where appropriate. All of the questions I ask will be questions submitted before the event, and I'm also inviting you now to submit questions via the Q&A function at the bottom of the screen. We want this to be your session, so if there is anything that you're worried about, you're concerned about, or you're hearing generally, anything you want to ask AJ, please pop that over to me, and I will get through as many as I can, make this as relevant as possible for you and helpful to you when looking at your investments over the coming weeks and months. So let's get into this, AJ. Welcome. Thank you again for joining all the way from Utah. Can you start by introducing yourself and the strategy you employ for our investors?
Sure. Absolutely, Darren. And again, thank you for the invite. Good afternoon, everyone. And I'm delighted to be here. My name is AJ Krishnan. I've been at Wasatch Global Investors. We changed our name from Wasatch Advisors to Wasatch Global Investors a year or so ago. I've been at Wasatch since 1994, started out on investing on the domestic US side, and have been investing in international markets since 2002. I launched the Emerging Select strategy, which is where SJP is invested in, and have been managing that since inception, since 2012. And I'm also helped lead the whole emerging markets team here. I also run a dedicated country fund, dedicated India fund, and have launched that, been running that for the last decade as well.
So starting you off, there's some chunky topics to get into. Emerging markets is always an area of interest for many people, and a wide-ranging number of things you can end up talking about. But in terms of looking back at recent years, so I'll deal with where we've been first. We're always told that volatility is the friend of the active investor. When you look back on recent years, do you believe that the volatility of the market has been in your favor or not?
It has and it hasn't, right? It has up until 2022, and then 2022 was a tough year. So we did get hurt in 2022. As active investors, yes, while we pay attention to the macro, we are trying to take advantage of the unique opportunities that are presented by individual companies. And so in that sense, yes, if the market misprices assets for whatever reason, that is an opportunity for long-term investors like us. Just to step back and give you a sense for how we invest and how we try to sort of make sense of the universe, we are trying to find what we call high-quality, enduring businesses. These are businesses that we can buy and own over a 5-10 year period. Why is that important? Because over the very long term, the market tends to be more inefficient. In the short term, markets are quite efficient. Things get priced pretty effectively. But what the market fails to appreciate is the time arbitrage. And that's where long-term investors like us can really score, because we can identify these great businesses and then let time do its trick. And that's the hard thing to do. People are generally impatient and they try to move with the short-term swings. So in that sense, yes, if there's volatility in the market over the short term, that presents an opportunity for us to accumulate shares in some of these long-term companies.
So one of the questions amongst the questions that I got from investors before the event, there was questions over what went right in 2020, what didn't go so well in 2022, and whether there is a delicate balance between one happening again and the other. Trying to group these things together, can we talk about 2020? It feels a lifetime ago, but it wasn't. Can we talk about 2020, what went right? 2022 and maybe what didn't go so right, and what you did and what you continue to do to counterbalance that?
Yeah. And so our process hasn't changed, whether you look at 2020 or 2022, but there were certain factors in the market that caused the divergence in performance. In 2022, I'd say we used that volatility to our advantage. If you recall, March 2020 was the bottom in the market. There was all the concern about COVID. Nobody had any idea of how long that would persist. The vaccines weren't out broadly. And so there was a lot of concern globally. When we saw the short-term dislocations in the market, and when we identified the businesses as being solid over a long period of time, we decided to actually add to all those shares. And that turned out to be a very good move, increasing our weighting in some of those long-term companies. That's what led to that significant outperformance. At that point, if we had panicked, or if anybody, market participant had panicked, said, okay, we don't know where the end is, I think they would have hurt themselves by trying to time the market and get in and out. We had done the work through that period. We stress tested all our companies, went through the analysis of which of these companies will survive if the world truly shuts down for 3 months, 6 months, 9 months. And we went through our list and said, okay, there's hardly any companies that we would be concerned about. So the thing we have to do is do no harm, i.e. don't act too much. And so we stayed the course, stayed still, but also opportunistically added to some of those names that had been sold off a little bit too much. And that's what led to the significant outperformance in 2020. Now, fast forward to 2022, we are executing to the same playbook, i.e. trying to find companies that can compound their earnings and own them for the long term. So that begs the question, what happened to 2022? Why was it so bad? As they say, your strength can be your weakness, and this is one instance of that. When we looked at the long term, starting at the end of 2021, we could still see that the 5-year picture looked quite solid for our companies. What was different at the end of 2021, and I'll use 2020, end of 2020 versus the end of 2021 to look at the valuations in the overall market. If you looked at the absolute multiples or earnings multiples or EV to EBITDA multiples for the portfolios, it did not look very different. However, entering into 2022, what was different was there was a shift in the market regime, if you will. There was indication that the Fed was going to increase interest rates for a variety of reasons. Now, that didn't happen until March the following year, but that was the precursor. What that meant is all assets were going to get repriced. So where the average stocks were previously trading, say, at a 30 multiple, this is at the end of 2020. At the end of 2021, the market recognized that all those things need to be reset to a 15, 16 multiple, i.e. could get cut in half. That was something we didn't fully appreciate, and that's what hurt us. The good news is when we looked at our underlying companies, they still reported solid double-digit earnings growth, north of 25% through the period. So these are not broken companies. But the mistake we made was not fully anticipating how much the Fed was likely to raise rates. Again, in our defense, that's not our forte. We do not try and anticipate where the Fed is going with interest rates and so on. We try and focus on the underlying quality of the businesses, and I'm happy to report that if you look at our turnover, you'll see that we haven't had to make much of a change in the portfolio, which means we still own great companies. They are still compounding their earnings. But yes, that the market took a reset. The positive to that is if you're still holding those companies and they're compounding earnings at a healthy rate, the valuations have come into such a degree that from here on forward, it looks quite exciting to own this portfolio. And it's also worth pointing out that, over the last decade or so, we've had the headwind from the US dollar strengthening. That is also likely to abate, and we can discuss in more detail why that is the case. So I think going forward, the valuations have corrected, and you will get 100% transmission of the underlying earnings power of these companies, which means emerging markets is in a pretty good spot.
Are you able to give us one or two examples of companies that are in your fund so we can get a better idea, a more detailed idea of what didn't go well last year and why you can continue to retain faith in those businesses?
Yeah, I'd say, almost every company was hurt last year. The company that is, I'll take some of our top holdings to discuss names that have done well. But one of the names that hurt us particularly was Silergy. It is a semiconductor company, analog semiconductor company, listed in Taiwan, but has design centers in both Shanghai and San Jose, California. Analog semiconductors they don't get the hype of, say, an Intel chip or an NVIDIA chip, which people are more familiar with, possibly. But these are ubiquitous chips that go into almost any device that we use. So if you use a laptop, there's a power management chip that regulates the power. If you use a cell phone, there's a chip that goes in that. I presume this could also go into washing machines and dishwashers and so on. They're very cheap products, 50 cents to $1 a piece. but they are essential products. If you looked at the valuation on Synergy at the end of 2020, this was trading at an 80 multiple. Now, any person in their right mind would say you should not be paying 80 times for any company. However, in 2021, that stock doubled. Why is that? Because they grew their earnings more than 100%. So at the end of 2021, we are now sitting with a stock that is trading at a 90 multiple approximately. And still looking at the prospects for the next 5 years, we can see that this is going to compound at 30-40% rates. However, at that PE, when the momentum goes from 100% earnings growth to a 50% earnings growth, and there's a shift in interest rate regime, that stock got hit pretty hard. That was one of those stocks that got cut in half almost. Having said that, as I look out, and we visited the company a couple of months ago in Taiwan, the long-term prospects are still intact. As I look out over the next 5 years, we think this company has the opportunity to be a multi-bagger from this level on. So we're quite excited to continue to own that company. That's an example of a business that got hit pretty hard, still generating very good earnings growth or generated pretty good earnings growth, and the 5-year outlook is still intact.
Excellent. And that brings me very conveniently onto a subject that we talked about when I've interviewed you in the past. And I find the whole subject of it fascinating. And now, a couple of years ago, you used the phrase in an interview that semiconductors are now the new oil. And at the time, I remembered it, but it didn't necessarily hit home as much as it would have done now. So this is now slowly coming into the mainstream of semiconductors being the new oil. Where are we on that story now? How is the fund positioned for a semiconductor shortage, which will then lead us on to China and Taiwan, which is impossible to ignore, but a potential global event. So therefore, how do you unpick that question?
Yeah, no, that's, I think, a key topic that we should all be paying attention to. We all saw the impact of a shortage in semiconductor supply, right? I'd seen some data that said in 2021, about roughly 7 million cars were not produced because they did not have access to semiconductors. More and more cars have semiconductor technology embedded in it. Even if you don't use driverless cars, your cars have functions of detecting pedestrians, detecting other cars, keeping you in the lane, and so on. All of these technologies are enabled through semiconductors. That 7 million cars that did not get shipped resulted in roughly a $200 billion shortfall for the industry. And that's just one example. The point is that semiconductors have become ubiquitous, and think about how we all operate now. We are all used to dialing in remote, talking to each other. We expect to have good connections, good connectivity through either Zoom or Microsoft Teams and so on. So it's become more and more pervasive. People want to be able to access resources anywhere at any time. That means you have to rely more and more on technology. However, there is, a difference of opinion on how the world should look, as we've seen with the US and China. Both are trying to sort of dominate this factor of production. Why? Because going forward, unlike in the last 50 years, everybody was jockeying for access to oil. Now everybody's going to be jockeying for access to semiconductor technology. And if you look at the history of semiconductors, Silicon Valley has its name for a reason, because that's where a lot of the semiconductor technology originated and a lot of it was built. And we're talking the early 90s. Over the subsequent 25 years, Taiwan has emerged as a leader in leading-edge semiconductor technology. If you think back to 25 years ago, Taiwan actually got its initial start from technology that was produced in the US, and it was given to them by the US companies because they were trying to help the small island nation generate or build its economy. Fast forward 25 years, TSMC now has the lead in semiconductor technology. They have overtaken Intel, who used to be the leader. And most of the world's leading-edge semiconductors are produced in Taiwan. So that becomes now a key pawn in this game of who's going to have access to technology, this leading-edge technology. And that is why you're seeing all the tension around Taiwan. Of course, then the next logical question is, so what if China takes over Taiwan? What happens to our access to semiconductor technology? This is something that you may not be familiar with, but in here we joke about it. President George Bush famously remarked, "Why did God put our oil under their land?" Because it was an important factor of production. and referring to the Middle East. I think we are in a similar situation with semiconductors. Why are all the semiconductors being manufactured in Taiwan? And who should be controlling that? The problem with China making an overtly aggressive move on controlling Taiwan is that all of the tools that are needed to produce leading-edge semiconductors are still made in the US or the Netherlands. So companies like Applied Materials, Lam, KLA-Tencor in the US, and then ASM Lithography in the Netherlands are the key technology companies. So the moment China does anything with Taiwan, they will lose access to those tools, which means they will be frozen in time. So that's, I think, one of the gating factors why China will not do anything over it. That's sort of the governor, if you will. So one of the things we should all be watching for is there going to be an emergence of the tool companies in China? And we are constantly monitoring that. Companies like Shanghai Microelectronics, is there going to be the analog for an Applied Materials or a Lam Research, KLA-Tencor emerging in China? The day that happens, I think Taiwan is up for grabs. And that's something that we are mindful of. You asked the question of how are we positioned. We have some of the semiconductor companies already in our portfolio. Silergy is a company that will benefit from this demand for semiconductors. What is likely going to happen is that the world it's going to be a multipolar world. There's going to be an axis around China, and that's going to create its own supply chain for semiconductors, and a US-led axis that's going to build its own supply chain. So there's going to be redundant capacity that's going to be built globally, which means it's going to be a positive for the tool companies because they'll get to sell twice as many tools as they would. The overall utilization of those factories may not be as high because you're building in spare capacity. So one could argue that the returns on capital for some of the fab companies, the manufacturers, may go down. But for the device manufacturers who are using these factories, they will have access to more factories to make their product, and that's going to be a good thing. We also own LaserTech in the portfolio, which is another semiconductor tool company. They manufacture the machines that are used to aid in one step of the process, i.e. The inspection of the masks that are then used to make the chips. I don't want to get into the details, but suffice to say, it's one of the tools that will be needed to make next generation semiconductors. So companies like LaserTech will benefit, companies like Silergy will benefit. Also, we are looking for new opportunities in China. China is going to try and build its own semiconductor industry. They do not want to be beholden to the US. They learned the lesson at the end of 2018 when the US put those sanctions against Huawei and ZTE. So they will press hard to try and create their own device industry. So companies like Sinovel, companies like SG Micro, these are companies that we own in the portfolio in small weights because we are still trying to understand the long-term opportunity and the competitive advantage for these companies, whether it is sustainable. They look well positioned today, but we are going to proceed in a measured manner. So we are slowly increasing our allocation, but I think the real price will be if we can find some of those tool companies in China, because that's going to be a secular grower.
Sure. So there's two things to unpick from that. So one, you seem so as investors and as the public, we are bombarded with negative press, negative headlines, 24/7 news, social media. I bang on about that in every one of these interviews about how that influences investor behavior. Absolutely does. It sounds to me like you're maybe not relaxed, but certainly you think that the outcome of military conflict here is quite unlikely with the current state of affairs. But secondly, the longer term outcome of this is that countries become more self-sufficient in their semiconductor production or reliant upon other sources of semiconductors, yes, even if it's not themselves. Is that what am I reading that right here?
Yes, and that's going to present opportunities. So it's one is the conflict around semiconductors. The other is the need to build redundancy in the supply chain for all products, not for a number of products. So in pharmaceuticals, countries and companies are trying to build redundant capacity as they are in automotive components, electronics manufacturing, and so on. One of the things that COVID highlighted is the over-reliance on a single supply chain is actually detrimental. I'd say the last 20 years, the world has pushed on, let's lower the cost, and was seeking the lowest sources of production, lowest cost sources of production around the world. They happen to be in China. Now you overlay what happened with COVID, they recognize that these disruptions actually increase the cost. And if you don't have access, it doesn't matter how cheaply it is being produced. If you don't have access, you don't have access. And that's the reason you're seeing the reconfiguration, if you will, of the supply chain. People talk about nearshoring and onshoring. I think onshoring is maybe too lofty a goal. What you will see is reshoring, i.e. companies moving production from a single site to multiple locations. India is a beneficiary coming out of this. A number of companies have looked to India to be a manufacturing source. Manufacturing has never been a strength for India just because the infrastructure is so abysmal. But the Indian government recognized this opportunity and has made significant progress in improving the infrastructure in certain clusters. Most of the country is still pretty dire. There are still villages and towns that don't have reliable power. But the government has created clusters around some of the cities to take advantage of this move, call it the China plus one trade, if you will, of supply chain moving to different locations. And so I think there are certain countries that definitely benefit. Vietnam is another one that comes to mind where we're seeing significant change on the ground. But certainly India looks poised to benefit as well.
So a couple of people did ask us to drill a bit further down into India, and I plan to do that later on in terms of the what next bit of this. But unfortunately, we're still dealing with the what now. I always think that emerging markets managers have to. I think in more developed nations that it's company specifics, and you don't necessarily have to get involved in politics. I'm not going to ask you for political views. We discussed that beforehand and how complex everything is, but we have had a couple of questions about actually you're working in a universe of stocks that don't just have to take into account the underlying economies and things like that. The politics of some of these countries is highly complex. Even US, China, and India, if you just take those three, massively complex. Somebody's asked how much you have to take the politics into account rather than the actual company themselves. Can you talk a bit about how you can marry those two things up? Because the best company in the world could just be derailed by politics and policy, etc. So how do you get an insight into that, and how do you actually deal with that when valuing a company?
Sure. And that's, I think, a very important question that we have to pay attention to. Yes, you are right, Darren. Our fundamental task is to identify these great businesses where they can compound their earnings. But ultimately, our investors care about hard currency returns. So if I own the best company in Turkey and the Turkish lira has depreciated 70%, and I've given away all the gains, it doesn't matter how great that company did in Turkey. And so we are mindful of that. So we have a macro framework that we use. We are not macro investors. Again, our fundamental task is to find these great businesses, but then we have to overlay the macro to make sure that we don't give it up all in terms of currency depreciation. So we are interested in the politics in as much as it impacts the currency in each country. You can have poor politics and poor governance in certain countries, but the currencies may still do okay. So the main risk factor that we are trying to assess is the propensity of a currency to depreciate. So there are three models that we use. We use the Bloomberg Country Risk Score, we use the Citibank Early Warning Index, and we subscribe to the Economist Intelligence Unit to understand their risk scores. We use those three models to help us predict how likely is it for the currency to depreciate going forward. And we adjust for that in our expected return. So for instance, if I find a company in India, we know that the Indian rupee has depreciated between 2.5% to 8% per year over the last 25 years, and is likely to continue to do that. So we will use these models to assess, is the risk above average or below average? Today, when I use the Citibank Early Warning Index, it shows me that the risk is substantially below average for the Indian rupee to depreciate. We also use the Bank of International Settlements to assess the value of the currency at each point in time. Today, the value of the currency is cheap. It's below fair value. 100 is considered fair value. The Indian rupee is trading at 95 based on the real effective exchange rate. So we use these factors to assess. So the conclusion today would be that India is likely to depreciate in that band of 2.5% to 8%. So when I look at an Indian company, I look at what the earnings are going to be. I assign a terminal multiple. I know what the expected price is going to be 5 years out into the future. I back into the price today to come up with an expected return, and then I give it a haircut of that 2.5% to 8%. Today, it's more likely to going to be at the bottom end of that band for the factors that I just mentioned. But we go about it in that systematic manner. However, and this is very important, we try not to write off countries based on the macro. For instance, Brazil, we can all agree, has not been the best managed country over the last several years. However, one of our best performing stocks, and I'm going back to the inception of the strategy in 2012, has been a Brazilian company. They have compounded the share price at about 18.5% per year in US dollar terms. 18.5% is substantial.
And which company is that for our listeners?
It's WEG. It's a electric motor manufacturer. Now, in Brazilian currency, it compounded at 29%. But because the currency was depreciating in US dollar terms, it has compounded at 18.5%. And that's the adjustment we're trying to make. In Brazil, the currency has depreciated about 10% per year. So you need very strong earnings growth and very strong compounding to be able to outrun that. But that's kind of how we try and address the macro issues. Having said that, we did not pick up on the Ukraine situation. None of these models flagged it. When Russia invaded Ukraine, our initial reaction was this is likely to be, it's going to be more like Crimea and it will pass, but it did not. And so that was a place where I'd say the models failed to predict the risk factor.
Because you've gone towards currency, I mean, what are your thoughts on the US dollar's future as the global reserve currency? And certainly, is it at risk in the near term from the Federal Reserve seemingly devaluing it? I've had a couple of questions before and a couple of questions during on this. How much
not so.
Take into account that?
The short answer is yes. So if you look over the last decade, if you look over the last 20 years, EM has outperformed most markets, or certainly in line with the S&P. So, but over the last 10 years, the EM has underperformed substantially. It's been roughly 2.5% for the broad index over the last decade, and for roughly the same for the small cap index, whereas the S&P has compounded. S&P index in the US has compounded at almost 13% per year. So if you take the view of the last 10 years, it feels quite abysmal. Why am I wasting my time? Why bother? EM hasn't really returned much. If you pull the covers back on that a little bit, you will see that over the last decade, there has been a significant headwind from the dollar strengthening. And so even though the companies were doing well, you lost a lot in the dollar appreciation. The example of WEG being great, where in local currency, you made compounded at 29% per year. But then when you look at it in dollar terms or UK pounds, it will have compounded at about an 18% rate, which means you're giving up a lot for the currency. We think that period of dollar strengthening is behind us for a couple of reasons. Yes, you talked about the Fed action, but it is more than that. I think there are a couple of reasons. The first one being the weaponization of the dollar. If you recall what happened with the Ukraine conflict, the U.S. Restricted Russia's access to their foreign exchange reserves. Today, there's roughly $13 trillion in the world in foreign exchange reserves held by various countries. $3 trillion of that is held by China, 600 billion or so by India, 600 billion or so by Russia, and so on. When the U.S. put the restrictions on access to the foreign exchange reserves for Russia, it sent a signal to foreign finance ministers around the world, which it basically said, if you cross swords with the U.S., they could restrict your access to your funds. So now there are governments in China and other countries sitting there saying, do I really want to have this IOU from the U.S. government? And the answer is no, especially for China, given that they might cross swords with the U.S. Over Taiwan at some point. They do not want to be in that position. So they will start to try and move away. However, that is easier said than done because there is no other alternative. There is not enough gold in the world. There is not enough Swiss francs or the Eurozone currencies either. So they are caught between a rock and a hard place. Having said that, you are already starting to see moves being made by these countries to sort of break the hegemony of the US dollar. Most recently, China announced an agreement, or at least has been in talks with Brazil to conduct their trade in renminbi. China has been talking to UAE and other countries in the Middle East to, again, conduct their transactions in renminbi. India has done the same. So slowly, you're starting to see these countries pick away and try and move away from the dollar. That's going to be a secular shift, I think, where people are going to try and break the dominance of the US dollar. So not just because of the Fed policy, but mostly because of geopolitics and not wanting to be beholden to the US government. So I think that's a secular shift that is underway, which means as emerging market investors, going forward, you should be able to get the full impact of the underlying earnings growth of these companies. You will, like the Brazilian company, which lost almost half its return because of the currency depreciation. If you had kept it in Brazilian real, that stock would have given you a 16-fold return, 17-fold return. Instead, you had a 6-fold return in US dollars. that's the delta that you may be able to capture going forward. So we are quite bullish on emerging markets as a whole, and we think there's going to be this added benefit of the dollar not strengthening.
I think what we're highlighting here when we're talking about all these different things that have to be taken into account with emerging markets companies is exactly why in our risk reward documentation, they are high risk funds. There are a lot of different variables going on, maybe a lot more than conventional developed companies that people are used to, the more boring stuff that tend to form a lot of people's investment. I think what we're talking about here is a high risk niche area where the knowledge and the almost feet on the ground here knowledge is so crucial to understanding what the risks are and taking that into account along the way. So that thank you for highlighting that. There are a number of questions coming in. So if this feels from now on a bit random,
Okay.
it's some big chunky stuff that I do want to get across.
Sure.
One person has just highlighted something that I wasn't going to ask, but regrettably, just because I forgot to list it. All the things going on that we're hearing about with banks at the moment, particularly within the US, but obviously Credit Suisse in Europe, etc. What are your views on the banking crisis? What are your exposures to financials? How do you take into account some of the news stories that you're seeing on this at the moment?
Yeah, and I think the two important topics that are worth addressing: the banking crisis that seems to be gaining a lot of momentum or mileage in the press, and then the talks of recession. Both of those are Western-centric phenomena, if you will. The U.S. is going to be in a recession, likely. The European region is also going to be under stress because of the conflict and the disruptions caused by the Ukraine conflict. That hasn't been resolved yet, so we don't know how that's going to pan out. But those are stressors on those markets. The banking crisis, yes, is a serious issue in the U.S. But if you step out and look at emerging markets, India is going to grow its economy at almost 7%. China is just opening up after a 3-year hiatus. These are large economies that are going to grow at pretty healthy rates. The Indian government is thinking of, they seem to have inflation mostly under control. The next move is likely going to be a cut in rates. So it's quite a bit different than what we are seeing in the West. So I think it's important. Yes, we are all exposed to the news that we see and hear in our, call it location. But that's not, I think the mistake would be to extrapolate that to the rest of the world. The rest of the world is behaving quite a bit differently. So while there's a banking crisis in the US, when I look at the banks in India or other parts where we own financial service companies, things are looking quite good. In fact, the interest rate environment in India is quite benign. Companies that we own in the strategy, like HDFC Bank and Bajaj Finance, have announced earnings which were very strong double-digit earnings growth rates, and the outlook is quite positive. Bajaj, in fact, grew its business about 29% in the most recent quarter that they reported last week. The point being that it is important not to get clouded by what we are hearing in the press, in the mainstream press, in our domestic economies. What is happening in these emerging markets is quite a bit different. So we we have significant exposure to financial services. We like that long-term. Financialization in these economies is a big theme, and we intend to stay the course with that.
It's interesting because I think one of the questions we've had during this event as well is, do you anticipate high interest rates being here for the foreseeable? And actually, many of these countries that you're investing in didn't have zero rates in the first place.
And that's
so
a key point.
High is a relative concept, isn't it? So
yes.
Is that, as you say, is that the key point here, that higher is different than 0 to 4?
Yeah, no, for India, for the US to go from 0 to 4.5% was a big deal. But countries like Brazil are almost at the point where they're going to start cutting rates. You're going to see a similar situation in India. And at those high levels, moving things around a little bit does not mean a whole lot for the market or the economy. Most of these countries have experienced high levels of interest rates and high inflation, and they've worked through it. For the US, starting the 2000s, we went into this environment of keeping interest rates artificially low. Now we can debate on the merits and demerits of that. But I think those caused problems. Those caused some of the asset bubbles and so on in subsequent years. Most emerging market countries did not have that luxury. So I think it's a very different situation, and it's important to keep that distinction in mind.
It's interesting points. I said I'd come back to India just because a couple of people have asked before the event and one's asked during. You obviously manage an Indian fund as well, separate to St. James's Place. how do you feel about India as a overall economy? China gets a lot of the attention for obvious reasons. But India, from an economic point of view and a projected economic size, is not that far behind. So how far do how do you see the fund opportunities in India? I know you have an overweight position. I think you have an overweight position within our fund, where India is concerned. How do you view India as a long-term investment potential, and what comforts you about that?
Sure. And I mentioned earlier that the last decade has been a tough period for emerging markets in general, but India has been the bright light even in the last decade. What has been not a great environment for EM and not a great environment for India either. Since 2013, the Indian market has done quite well, and our India strategy has also done quite well because we are again trying to find the same profile of companies that can grow. I'd say we joke internally here that over the last 20 years, we made money in India in spite of India. And finally, there's a secular tailwind emerging. So if you compare India and China, in 1991 is when you saw the big push in China on this path of manufacturing competitiveness. Shenzhen came into being around that time period. You saw a lot of investment from the Chinese government and from countries like Taiwan in building a manufacturing base. That led to the 20-year economic boom in China. India has never had a secular tailwind because it's a messy democracy. You cannot really issue edicts to make things move in a smooth manner. However, in the last 5 to 7 years, you've seen a significant number of reforms that have been enacted in India. Whether it's the simplification of the tax code, whether it's the introduction of a national identity card program that enables financial inclusion, the bankruptcy code that was ushered into law, inflation targeting. These were all seismic events that have been enacted over the last 5 to 7 years. What that means is that finally you're starting to see a secular tailwind. And then fast forward to 2019 and 2020, with COVID and the China Plus One strategy, you started to see an uplift in manufacturing as well. Why is that important? Because India needs to create roughly 8 to 10 million jobs each year for the young population that it has. But unlike the common caricature of Indians sitting in Bangalore typing on a keyboard, most Indians don't have access to computers. The vast majority of India needs jobs pounding sand, literally pounding sand at the bottom of the pyramid. They did not have the opportunity to create that. But now with this move to manufacturing, I think that's going to be a key tailwind for India. So if you think about our thesis on India, it has been the financialization, the digitization of India, and I'll talk about digitization here in a second. But now there's a new leg or a new vector of growth, which is the manufacturing base or industrialization. That's what's going to put India on a secular path over the next decade plus. So going forward, I think it's going to be much easier to make. And to your point, Darren, you're right. Earlier on, China used to gather most of the limelight. But today, finally, people are waking up to the promise of India. And it is easy to understand, right? If you visited China in the last few years, everything is impressive. The airports are impressive. The subway system is better than anything I've seen in the United States. Maybe not as good as the tube system in the UK, but certainly better than anything here. The point being that the hard infrastructure that you can touch and see and feel in China is way more impressive. On the other hand, when you go to India, you're surprised that the country even works. It takes 3 hours to get from your airport to your hotel. Everything seems to be a mess. However, what people are failing to appreciate is the underlying digital infrastructure that has been put in place. The two examples I would lean on is the creation of the payment infrastructure in India. The Indian government, not the government, it was basically the founder of Infosys, which is one of the largest IT service companies. He's a billionaire. After he retired from Infosys, he wanted to give back to society. The way he decided to do that, rather than create just charitable foundations, is work on this public infrastructure. He called it for the public good, building this payment infrastructure where now companies can use the payment infrastructure and circumvent Visa and MasterCard and not pay those fees and provide it for free. What that does is it reduces the cost of doing business for banks and for merchants across India, which means it raises the participation of the very poorest people in the economy. That was a seismic event in India. Fast forward to last year, the government, the same group also launched another initiative called ONDC, Open Network for Digital Commerce, where they are building an Amazon-like network and giving it away for free. In most countries, Amazon charges a 15 to 25% take rate from the participants. And here the government is building something and that they're giving it away for free. If that takes hold, again, you will have lowered the cost of doing business for all the participants, for all the stakeholders. These are huge events that people that go unnoticed in India, because when you go to India, it's like, oh, nothing works here. So I'd say the digital infrastructure, the manufacturing push, the financial inclusion that is underway in India is what's creating the long-term opportunity. So we think India is truly set for the next decade plus. And mind you, even in this tough environment, like I said, in the last 10, 20 years, India has outperformed. India has outperformed China by a mile. Again, because people don't really pay attention to India that much. So those of us who've been investing there for a long time have been able to pick up these opportunities and participate in the compounding of the earnings stream.
That's really interesting. Thank you for that. We've had a couple of questions. So I think you touched on how the Western news flow may differ from local news flow in the areas that you're investing and the markets you're investing. Yeah. And I think that's an interesting point, probably on pretty much every topic going. But in particular, one of the things that was asked up front was about COVID. Now, in the UK, it's unbelievable how far we've come in the last 3 years as a result of the vaccine development and rollout, etc. But I think it's fair to say it's still more of an issue around the world in some places than it maybe is in the UK and US to some point. So how much in the areas that you're visiting or you're investing in and seeing these businesses, how much is it actually still affecting these companies on a day-to-day basis, if at all? And are there areas of the market where COVID has just changed it forever?
Yes, to both the questions. There is still an impact, but I think most countries, especially the poor countries, have recognized that they don't have the luxury that the West has. So even India, even when they did not have access to the vaccines, recognized that the best way to move forward is to try and acquire herd immunity, which meant a lot of people would die, which is unfortunate, but that is the price that countries like India had to pay. Now, of course, they've moved forward. India is one of the largest manufacturers of vaccines in the world, and they've moved forward and have been able to get the vast majority of the population inoculated. So I don't think it's an issue. Having said that, the most recent variant is starting to perk its head up, and you're starting to see the case numbers go up. I think the sad reality is a number of these countries recognize that they have to move forward regardless of whether there's a vaccine or not. And so I'd say they have done that. So I don't see it necessarily as a risk factor because countries have learned to adapt to the reality that they will have to work with COVID. Has that increased the cost a little bit in some areas? For sure. But it has also created opportunities. For instance, in India, there's more awareness on testing, all kinds of testing. And so more people are using the medical testing services. And that creates an opportunity for companies like Dr. Lal Path Labs, which is a business that we own in the strategy. They provide testing services, starting from very mundane blood work to test your cholesterol levels and so on, and to COVID testing at the other end. So those, I think it's just raised awareness for certain services as well. So I'd like to think of, does it present opportunities? And I'd say it has presented opportunities. There's also a distinction in terms of the quality of the provider that is different providers bring to the table. So not all things are created equal. There were some companies that were engaging in COVID tests that were not very effective. One couldn't tell if this was the real deal or not. So I think that it has been a shift in mindset as well, that you need to pay attention to the quality of the underlying provider. And so that's creating an opportunity for the good companies. So
there are 2 or 3 questions I need to get to. So this will feel zigzag for the last section. But one of the things that a couple of people have asked up front was about the ESG factors of environmental, social, corporate governance factors when investing in China in particular. Maybe it's fairer to say all emerging markets rather than just China. But how do you marry up your ESG process with our demands on you with what we want as well? How do you marry up some of these ESG factors with companies you're investing in emerging markets?
Yeah, and so ESG has always been central to the way we've conducted our research. It's nothing new, especially the G part. The governance part is non-negotiable. China is a unique beast in the sense that the governance has two aspects to it. One is at the company level and one is at the government level. What does the government intend to do? And that's what makes China tricky. If you look at our overall allocation to China, it is substantially below the benchmark. Why? Because it's not because there's a dearth of high quality businesses. We can find very interesting high quality long-term compounders. However, when you overlay this, the G part of ESG, i.e. what is the government's intent? When will they change their minds? That risk factor becomes very high. And so that's why we've had to moderate our weighting in China. So China is always tricky because of that aspect. On the environment side, they're making significant progress. We've recognized that the E part of ESG has to be taken or treated in context, i.e. you have to provide cost-effective solutions in emerging markets for these companies to execute to the E part of the ESG. It would be imprudent for us to sort of expect the same level of execution on the E part in some of these poorer countries if it is cost prohibitive. So what we look for from our companies is whether they have a plan to improve their E footprint, if you will. But we don't necessarily expect them to achieve the Western levels today. But we do want to see a path to progress, and most of our companies are are engaged in that effort. Given the nature of the companies we invest in, we don't invest much in energy or any of those extractive industries. We have very limited exposure to the companies that might be violating the environmental part of the ESG equation. So we tend to be more insulated than most investors because we tend to underinvest in those areas.
So, slightly random one, but somebody's just asked me a question. I'm going to read it out word for word. As a manager in a high risk fund, do you worry more than the average person?
Like I said, I started my career in investing in domestic U.S. equities in 1994. I don't think I worry any more or any less today. The things I worry about are different, for sure. Yes, like we alluded to some of the challenges that are unique to emerging markets earlier. So yes, the things that I worry about are different, but this is I view this as a very important task. If I do my job right, I'm helping people achieve their financial goals. That's an important task, regardless of the market you're in. And we take that very seriously. It's either you're setting people up for success or you're hurting them in the times of need. So we take that task very seriously. So I'd say I wish I was worrying less or more. Actually, I wish I was worrying less, but it isn't the case. And I'm not worrying anymore. I think the pressure has always been the same.
Good answer. So I always finish with a similar question like this. So if you were speaking to somebody who had a longer term investment horizon, and they wanted some emerging markets in their portfolio, would you encourage them to do that? And are you fairly positive on emerging markets over the long term as an investment strategy?
Absolutely. And for the reasons I mentioned. So if I were to just synthesize, yes, the last decade has been tough because even though some of the emerging market countries have done well, you've given up a lot in terms of the currency depreciation. That headwind is going to abate. If you look at the countries that we are invested in heavily, i.e. India and being the main one there, we think these are countries that are positioned to do quite well. So going forward, we think they should be able to grow their earnings at a substantial rate. Also, if you look at what happened in 2022 with the drawdown we've taken, valuations have come into a very attractive level in a number of these countries. So from this point forward, things look very attractively positioned if you have a longer term horizon. Now, in the short term, there are going to be some perturbations given what's happening in the U.S. Does the U.S. go into a recession? How does that bleed into the global economy and so on? But I look at valuations, I look at the long-term prospects, and I remain quite excited about emerging markets.
Thanks, AJ. I really could talk to you for hours about this, but unfortunately, we've come to the end of the session. I really appreciate how you've answered everything that's been fired at you, however randomly I've done those. To everyone listening or watching, any feedback, let us know. We will be back with another interview in September, this time with Sands Capital, who are one of our managers on the Global Growth Fund, which many of our viewers and listeners today will be invested in. From their investment style, I'm pretty sure that they will talk heavily about the US and technology sectors in particular. So one for you if you're interested in those areas. But Behind the scenes, thank you so much to Emily Taylor and her team for putting this together again. Thank you to AJ for taking the time to speak to us. I can see it's getting lighter behind you. I can see an outline of some mountains there. So it may be a more palatable time for you now. And thank you to everyone for dialing in. Please stay safe, stay well, and hopefully see you all again soon.
Thank you, Darren. Thank you, everyone, and have a safe day.